My guest today is Richard Flynn, Managing Director of Charles Schwab UK. Now, Charles Schwab has 13 trillion of assets. It's been around since 1971, has something like 10 million trades a day, 39 million brokerage accounts all around the world. It's a massive, massive company. Welcome. Delighted to have you here.
Great to be here. Thanks, Carl.
It's a perfect time for this conversation for a few reasons. One of those reasons is that the UK government, through a handful of initiatives, which we can get into, is trying to get more and more people investing. And that's great, but it's something that Charles Schwab has been banging the drum on for decades. How do you see that, given you've been on this path for so long already?
Yeah, well, I personally have worked for Schwab. Originally, I joined in 2005, and quite a lot has happened in the UK in the last 21 years. Certainly in terms of retail participation, which has grown. The government is trying to do more, but if you look at the numbers over the last 5 years in particular, retail participation has increased, but we're still lagging. I think we're lowest in the G7 in terms of retail investment participation. So the government is trying to help people to invest, and it has a vested interest in doing that because, when you look at the savings rate versus the investment rate, that's a key difference. And there's a cultural inclination for people to save cash. There's a fear of investing. And the government has a lot of work to do to try and get the UK to a place equivalent to the US, where there has been, over the last 40, 50 years, as long as Charles Schwab has been running as a company, a significantly increased participation rate across all sectors of the population. And one of the interesting things when I look at it is how the government is going about doing this. And there's a sense that they're trying with the ISA reforms and with a lot of the messaging that they're giving to try and compel people to invest, to move from cash into investing in stocks or in funds. In our experience, generally trying to compel people to do something is less successful than creating an environment that incentivizes them to do something. You can't really force people to do something. The key is to try and create an environment where they come to the conclusion that it's the right thing to do for them. I always think back to there's a fable, Aesop's fable, about the north wind and the sun. Where they're two great forces competing with each other to try and get someone to take their jacket off. And the wind blows and blows and blows, and the jacket is just held down tightly. And then the sun just gradually dials up the heat, and the person takes off the coat of their own volition. And it rings true for a lot of things. That's why these fables still resonate 3,000 years later. But I think in the terms of the UK's retail investment conundrum, it's very relevant.
I completely agree. And maybe to build on that, it's a little bit like the industry as a whole, for better or worse, mostly for worse, hasn't done a good job of getting people comfortable with the idea of investing in the UK, shown them how to do it. It's been all fire and brimstone and risk warnings to the eyeballs and so on. And so people, understandably, have shied away. If all of a sudden the government turns around and says, actually, come on guys, I've got, as a retail investor myself, I've got zero incentive to engage with that. I've been shunned, I've been pushed aside, whether it's by government or institutions. Why now, when it sort of helps you, should I come along and do what you want? And I think there's a cool contrast with the US where, there's probably a fair amount of cynicism in the 70s, 80s when the US was going on this journey, but it was a sustained campaign. It wasn't a year or 3 years, it was decades of work. And now it's 40% of the US stock market is owned by retail investors. Everyone's got a 401k. It's dinner table conversation. It's part of the culture. If that's the direction of travel here, great. I guess I'm optimistic yet skeptical that as an industry we've all come and alighted on that solution. I think Schwab has, in my experience, but I don't know that, your peers and or competitors have.
Yeah. I think when I look at the US and the UK, and obviously I travel there quite a bit and get the benefit of exactly as you've described, sitting, chatting with people at bars and talking about their portfolios, you know, which you don't tend to do in the pub in the UK.
No.
So there's a cultural gap there. But where that comes from, I feel, is the nature of the relationship people have with companies, you know, with the businesses that they use, with the visibility of some of these companies as investment opportunities and the relationship they have with their shareholders.
Yeah.
When you look at successful investors, and I think they're probably a little more prominent in the US than in the UK, you will be able to learn from them about the power of compounding, the power of long-term strategic thinking, and the way that investors can effectively plug themselves in, you know, to the capitalist system in which we live, to help themselves. Yeah. You know, and it doesn't have to be at significant levels of money. That's the big difference that's happened as a result of, you know, innovators and pioneers like Charles Schwab that dropped the barriers to entry. Yeah. You know, I mean, you mentioned we've been running since the early 70s. 1975 was the big break for Schwab as a business, because that was when the SEC effectively outlawed fixed commissions.
Okay.
And it was May Day 1975. And what happened then was, you know, Chuck realized there was an opportunity to say to all of his subscribers, because he had an investment newsletter, equivalent to Finimize, I guess, you know, which was giving recommendations to his subscribers. And he was able to say, look, you know, you would pay one of the traditional Wall Street wirehouses $200. Now, this is back in 1975 money.
That's big money.
It's a lot of money to buy these shares.
Yeah.
I will take that order for you and get it executed, and I'll do it at half the price.
Fab.
And so it was the birth of discount broking, and it allowed, through scale, then those commissions to drop and drop and drop all the way to the $0 that we and other brokers charge today. So these barriers to entry have dropped and dropped and dropped, which has increased, and it increased participation in the market. Yep. But the big difference, and this is where the UK has a challenge, is to turn that participation into engagement. Yeah. You know, that's the challenge that we're all trying to solve.
There's a couple of routes I want to go down. One is, you know, what does success look like? And maybe I'll come back to that, because maybe that's quite a nice overarching theme. But you talked about innovation, you talked about Schwab and its big break and being competitive on price. Let's rewind 10, 15 years, right? We've got zero commission platforms coming in. We've got fractional shares. We've done a lot of work as an industry around accessibility and price, at least headline price, seeming to be the big lever. We're pretty much there, I'd say, in terms of that frontier being table stakes. A couple of thoughts, I guess. One is, how do you think about innovation going forward, and where do you think the next frontier is? And then also, with price in particular, I guess, you know, Schwab, massive business, as we've said. How do you think about continuing to grow that business in the context of low-cost competitors?
Yeah, well, okay, there's a long one.
There's a lot in there, sorry.
That's all right. So first off, just in terms of what success looks like, you know, for our business and really the foundation of it, Chuck is still very active as chairman of the company, and he brings us always back to just do the right thing by the client every time. You know, if you look after the individual client, the business will be fine. Yeah. And that has always rung true for us. So every business decision we make, every strategic decision, we're thinking, right, through client eyes, how can we make the right decision here to help people? Yeah. That, for us as a business, I think distinguishes us from a lot of companies that have multiple different objectives. Our objective is very simple. It's put the client first. Yeah. And that's why we have 40 million clients globally. You know, it's why we've amassed the trillions of dollars of clients, the assets that we have. Yeah. It's the trust that people have in our ability to look after their interests. So success for us is maintaining that focus. Yeah. You know, because it's quite easy for a large company like ours, a global company, to find itself fighting multiple battles on different fronts, you know, and so, you know, bringing it right back to the origin is something that will always be our focus. In terms of the future, you know, if we look at the structure that we've got in the UK now and globally with low cost brokers and really a proliferation of platforms that people can use, you know, there are a lot of options out there. There's a lot of noise, you know, and you and I have talked about this before, about the best thing for investors is typically to try and ignore the noise.
Yep.
Focus on very, very clear, straightforward, jargon-free information that's going to help you make rational decisions.
Yeah.
Which are all too rare in investing.
Indeed.
And so then you look at what's next in the industry and what's going to make the difference in coming years, particularly with so much competition. There is incredible technological change, as you know, happening right now. And AI entering our industry, entering countless other industries, is going to be, it's going to present a lot of opportunity for people. I'm not just talking about investment opportunities. I'm talking about just how people can live their lives, how people can find ownership of their financial future. And some of the surveys that we've done of investors in the UK have shown remarkable appetite, particularly across young investors, Gen Zs and millennials, to use AI in their investing platforms, in their investing research. The numbers are incredible. I think 79% of Gen Z and millennials are currently using AI as part of their investment platform or research strategy. 22% of the older generations, so that is a really stark difference. And it's one that every retail investment company is aware of, for sure.
So do you think there's a risk here that the way in which retail investors are using AI runs, or maybe it's already happened, has run ahead of banks and institutions' ability to serve them the way they want with AI? And the reason I ask that is, you've probably seen it yourself, there'll be a smart piece of content produced somewhere in a financial institution, and someone wants to run it through an AI system in order to get multiple versions of it for multiple different ICPs or client types, and they get absolutely slammed by legal and compliance, and they just can't do anything with it.
The biggest issue about AI, we, like every other company, is investing heavily in AI, but very, very intentionally about considering, obviously, the legal ramifications of it, in terms of, where does the advice come from? Are the people who operate the LLMs are they responsible for the output of it, etc.? But fundamentally, again, bringing it back to what the right thing is for clients. In our business, trust is the most important thing. Money is driven by trust. Doesn't matter how much you're talking about. You've got to trust the company you're investing in. You've got to trust the people you're investing through. You've got to trust that your money is secure, that you're operating in a system where the assets that you have worked for are going to be secure. And so trust is absolutely everything. And I think the current issue with AI is that no matter how you're using it, you can't trust it 100%, at the moment.
Yeah.
And so, to implement that and embed it in a system which is really the foundation of which is the trust that a business has with a client. That's why I would argue that bank were probably a little wary about the use of AI in that particular example. And it's definitely one of the things that we're thinking about as a business of, look, how do we not compromise the trust that we have spent decades building up with our clients and instead help them understand that we are using it very carefully and that we will only use it to benefit them, whether it's through their client experience, whether it's through our operational procedures, etc. We're very fortunate because of our scale, because we have the ability to service clients with humans, and there's a lot of smaller fintech firms which, come into the market and have fantastic platforms, fantastic tech, but they've got chatbots answering client issues and client questions and client complaints. Fundamentally, we know clients prefer to speak to humans, and I don't think that will change too drastically, particularly when we're looking at larger scale investing. One of the other interesting things about AI is the regulatory environment, because it's not just banks and brokerages and institutions within our industry that are harnessing AI and working out the best way of using it. The regulator and regulators globally are currently working out, how to regulate AI. And, the FCA is working hard. The Mills report is going to be published soon, which is, I think, going to be an interesting piece of work. And I think the UK is in a pretty good place, from an industry perspective in terms of understanding that it could be transformational, but it also carries some risks. And I think the engagement between the regulator and firms in the UK has been really strong in the field of AI.
If I think about the challenges across the board and pick your area of fintech, there's been a bit of a dynamic historically where challengers are great at getting, let's take investing, some fund money in, zero commission, it's fractional, But as soon as I have a windfall or an inheritance or want to do something that you'd objectively say is serious, like buy a house or plan for my kid's future, that tends to happen away from the challengers and with the large established players. Do you think that's just down to the human element more often than not?
There's a psychological element to it for sure.
Yeah.
You know, people do tend to outgrow things, you know, and not just in the context of their relationship with brokers or financial institutions, but everything. You move from a house to a bigger house to a bigger house.
Yeah.
Most people, hopefully.
Yeah.
I mean, things change. Yeah. But, you know, I think when you consider your journey financially, there are very few institutions that are likely to be able to serve you from, you know, childhood through to retirement.
Yeah.
And so it's natural that people will find different stages of their lives being suited to different institutions. And that's fine. You know, people are a little bit less handcuffed to their institutions than they used to be.
Yeah.
You know, and again, the regulator has done well in enforcing an environment where people have the freedom to choose and to move, and that firms can't hold on to them through exit fees or things like that.
Yeah.
I think that's an important thing. That creates a dynamic of open, competitive, you know, markets, which is a key part of our industry. From a generational point of view, again, we're fortunate because of our scale that we can attract young investors and we can look after ultra high net worth people in retirement or trusts or entity accounts, etc. Not everybody has the ability to do that. So a lot of fintechs and a lot of people entering the market have to have a very specific target market as to who they are aiming for, not just for their business to be successful, but also for those clients to get everything that they need.
Yes.
You know, because you can't serve everybody with absolutely everything. You have to focus on what you're good at.
So there's a through line in everything you're saying, and that you touched on explicitly earlier, which is engagement. So let's spend a bit of time on that. How do you engage retail investors?
Yeah, it's a good one. Well, I think firstly, you have to position who you are, your credentials.
Okay.
You know, same with absolutely anything in business. Nobody's really going to listen to you unless they have an understanding of who you are.
Yeah.
You know, and again, for us as an established business, one of the biggest in the world, as we've talked about, that's a pretty handy calling card to put in front of people. That's going to immediately say, okay, these people might be worth talking to. One of the things that's really important to not just Schwab, but in our industry is clear, jargon-free English, communicating with people in a language and in terms that they understand. You know, when I entered the industry, you know, 24 years ago, and you do all the exams and all the rest of it, you realize there's probably 2 or 3 languages in this world.
Yeah.
And, you know, a lot of it is nearly, you know, intentional to try and make things look more complicated than they need to be. Yeah. And for retail investors, it's nearly the worst way to engage with them is to try and create what they think is a world that's beyond them. So speaking to them in jargon-free English is really important. And I do think the Consumer Duty has been very effective and impactful in forcing firms to reconsider how they communicate to investors. And then, you know, being clear about the product ranges, clear about fees. You know, clarity is what people want. You know, when you speak to investors of all ages, all wealth brackets, people really value clarity. And so they will engage with you if you've got that position, the reputation, and you're able to show your credentials, and if you speak with them with clarity and purpose.
Yeah, I think the credentials thing is important for getting their attention in a crowded, attention deficit sort of market, and then engaging with, like, speaking to people normally, frankly, is how you engage and retain them, right? So Finimize and Charles Schwab UK have worked together for a number of years now across events where we've had thousands of attendees, hundreds of thousands of people viewing, you know, recordings of events, thousands, tens of thousands of people reading the content we produce together. Could you maybe share a little bit about the partnership from your point of view and how we've gone on? Yeah,
well, I think it's been great. You know, we've been really happy with Finimize. As you mentioned, the engagement on the events in particular has been really strong. Yeah. You know, we decided to partner with you guys because there was a commonality to the messaging, you know, of encouraging participation, encouraging, you know, reducing the noise and having very clear information that will allow people to engage more with, you know, their own financial futures. Yeah. You know, when we look at what we've been happiest with around Finimize, you know, the global community is something that's really important to our international growth. You've got investors all around the world, as we do, and understanding that there are a lot of commonalities across investing globally, but also, regional differences culturally and how people engage. I think that was something that we shared, and that we realized, okay, we want to communicate with as many people as possible on as straightforward a manner as possible, and give people the tools to succeed. And I think that's the real, thread that runs through our offering and your connection with your subscribers and clients. And so that was a key part of why we connected with Finimize. I think the second thing, obviously, is a generational thing. We have, as I mentioned, clients of all ages, but it is a crowded place now, the global investing market, particularly for younger investors who have plenty of options of where to go. And so, we wanted to get in front of some of those people who may or may not have been familiar with the story of Schwab and what Chuck did in America. In the States, Chuck is a household name. Everybody knows Charles Schwab. It is, part of the culture there, less so in other markets. And so, our partnership was part of amplifying our messaging and the shared messaging that we have with Finimize about, retail participation, and actually giving people the confidence to move from just participating in the market to really engaging with it.
Yeah, it's absolutely a partnership in my eyes, in that, I say to the team, we have to earn your interest. There's a bit of a pun, but we have to earn our readers, our listeners, our viewers' interest every single day in every single instance. And so I don't take for granted that people on their lunch breaks, on their commutes, maybe in their beds, depending on what time zone they're in.
We're in the eyeball economy. Everybody's
exactly.
competing for attention.
Well, exactly. And so when we're able to work with someone like Charles Schwab and bring people together, that convening power is really powerful. When you sort of came in, and it was pretty clear that your thing, and I was going to say your whole thing, it's not your whole thing, but an important thing was just straight talking, plain talking. That's music to my ears. We're aligned, and then it's a case of, and I say this to almost anyone who'll listen, and I get on my soapbox about this, Finimize lives in service of modern retail investors, whoever they are, however they want to engage. And that's the journey we're going on, and that's the direction of travel, and we're not changing that. If anyone wants to come on that journey with us and reach these investors and help them along the way, absolutely fine, but we do it on my terms. And your terms are my terms, and therefore it was an easy partnership to get going, and I'm glad we've done it.
Yeah, absolutely. No, it's worked really well.
Obviously, tons of conversation around how to incentivize retail investors in the UK. We've got the Get Britain Investing campaign, to name the biggest among them. From your point of view, what are the policy levers that either you think are going to have the most success, and what are the ones that you'd like to see?
Well, in terms of policy levers, there are frictions which other countries don't have. Chief amongst them in the UK is stamp duty. Obviously, that debate has raged for quite a while. We've talked about it before, I think off camera, but there's an irony really to the fact that if the government was to relent and remove stamp duty from investing in UK companies or UK shares, then it would cost them, but they have to consider the upside. And that really is what investing is about. It's going to cost you, but you've got to consider the long-term growth of what you're trying to achieve. And that there is an irony to that. But what that would do at a stroke, obviously straight off, it would incentivize institutional investment, because remember, institutions have to pay that stamp duty as well. But it would allow an even playing field. And I'm saying this on our behalf as a US broker. If we want to promote investing from UK participants and just get people in the UK investing, that is a very straightforward policy one to consider. And obviously it's discussed regularly at the highest level.
Of course.
But beyond that, you have to show people the benefits of investing, and again, incentivize people to, understand it. So, make it part of the curriculum, teach young children and teenagers and students how to manage money. There was a report which I read Rishi Sunak fronting recently about financial literacy, and some absolutely breathtaking, depressing stats about how poor knowledge is across the country around the risks of staying in cash and the risks of inflation. You know, and they are very fundamental basics. And once people understand those risks, then they are at least in a position to consider, okay, well, now that I know this, right, what is the right thing for me? And then if a structure is set up that makes it easy for people to invest, a lot of the practical obstacles that the industry used to have. So now you can invest small amounts regularly. You can invest at low cost or no cost. You can move brokers easily. You have a huge choice of where to invest and how to invest. So, the industry has created these things. The question is just, again, moving away from participation towards engagement. That's the big next step for the UK.
I have a crazy idea. I'm going to put it forward. Tell me why I'm wrong. If you agree it could work, then let's march down to Parliament Square. Okay. The UK government gives every adult £1,000 in a tax-free investment account. You can't take it out for 5 years. You have to invest it. If you do nothing for 5 years, you can't touch it. You have to make at least one investment, and then you can withdraw after 5 years. I think that forces a national conversation about investing. Everyone's going to say, well, what did you buy? Or what are you going to do? Ooh, maybe I'll put 200 in this and 200 in that. It gets people learning by doing, which from a Finimize point of view, we know is a great way to get people investing. And it doesn't cost that much. Look, don't get me wrong, it costs a bomb, but it costs, give or take, 60 billion. That's the pensions bill in a year. So you just take everyone's pension for a year and you say, you are getting your pension, but we're just giving it back to you in a slightly different way. We can afford it.
Well, it's. I mean, in the US, they're doing that now with newborn babies.
Yes,
so 4 million newborn babies every year will receive $1,000.
Yeah.
And so that is an interesting comparison between this hypothetical in the UK and where the US is. And the impact not just to the market but to these people's lives will be transformational.
Of course.
And so again, it's back to the issue of incentivizing versus compelling. With something like that, you're giving people a reason to engage in the stock market, in a positive way, and in a way that is relatively risk-free for them because it's free money.
Yes.
Government money is always free money.
Yeah, well.
But yes, it is back to the incentivization and participation piece. You're getting people engaged in the market, but you're not forcing them in that way. And in the way that the ISA reforms arguably were trying to force people to do one thing and not the other.
Exactly. I guess my other big policy would be everyone has to give the government their email address in order to pay tax or something, or for the NHS. Just sign everyone up to Finimize. Give them a Finimize Pro account and they'll...
Well, we kind of lobby the government on a few things. I'll put that into consideration.
I appreciate it. Thank you. The other big way to incentivize people, I guess, is marketing, is advertising. And I'm reminded of the Talk to Chuck campaign that you had, 20 years ago at this point. Can you maybe share a little bit about what that was and how it all worked?
Yeah, well, we've talked about trust. Trust is absolutely central in finance, in personal finance, and in just psychology of humans. You need to trust people to do business with them. And the Talk to Chuck campaign was incredibly successful because at that point, Chuck had been running the business for 30 years. So we'd established the credentials that we talked about. He was very, very visible. He's one of the first founders and leaders of a business to put himself in the marketing and his name on the door. Okay. And you can't think of many companies, certainly at our size, where the founder's name is the name of the company. And that's why he and his approach is fundamental to how we run the business today. So the reason that the Talk to Chuck campaign was so successful was because for a lot of our clients, it felt like if they were speaking to someone who worked for Charles Schwab, they were getting the same kind of guidance they would have got from Chuck himself. And that's a really foundational principle to how we interact with our clients, and it will continue to be a principle for the next 50 years.
Got you. That sense of one-to-one, high-quality advice is probably something that retail investors around the world would kill for right now, given the massive IPOs that are coming and that have come. I'm thinking SpaceX, I'm thinking Anthropic and OpenAI before too long, and I just wonder how, a firm like Charles Schwab approaches these massive events where there's a massive call on, your advisor's time. There's a ton of competition from other brokers. Mm-hmm. How do you think about it?
Yeah, I mean, it's a great challenge, but it's a phenomenal opportunity to have engaged conversations with clients.
Yeah.
People invariably come to us at a time where they're making decisions.
Yeah.
And they're looking for help with making those decisions, whether they are making the decisions themselves or they want to partner with us to help advise them on their decisions. We have the ability to handle things as they see fit, as they want. Fundamentally, we talk to clients about the importance of diversification. We talk about risk as it relates to these kind of emotionally driven decisions.
Yeah.
There's a lot. We are humans. Every single one of us is subject to human emotions. Fear and greed drive an enormous amount of decision making.
Yeah.
And so what we try and do is apply some reason and logic to helping people make those decisions. And times like this, it's really important to do that. Equally, when people are engaged, you want to promote that engagement and say, okay, well, if you are looking at these companies, let's look at other areas. Let's look at companies which might also be of interest, but that you may not have read about. We have at the moment, for example, we have a phenomenal tool called Schwab Investing Themes, where we have 40 plus, I think it's 45 different themes, which investors can once you have a Schwab account, you can go in, and they cover incredibly interesting areas. So space exploration, which is a big one right now, renewables, pets, water technology. So if people are thinking, right, I want to invest in themes which are likely to be either dominant or growing in the next decade plus. Imagine if someone had said, chips.
Well,
microchips 10 years ago.
Yeah.
Pretty cool theme to have someone to have introduced you to. And then there are things where, particularly for younger investors, where values are arguably more important than valuations. They can look into themes like companies creating cancer treatments, that where investing in those companies can result in major breakthroughs. That's something where people will make a decision based on what they're really looking for as an individual, rather than what's just bright and shiny and taking up headlines in every newspaper of the day.
It's interesting you talk about values on the one hand, but also emotions on the other, and it's doing a couple of jobs. It's allowing people to invest with their values, but also de-risk the emotional piece. So let's say there's a hot space company or a hot chips company or what have you. Rather than making the emotional decision to maybe chase it at astronomical valuations, pun intended, maybe I go into a basket. And so I have the exposure, I've scratched the itch, but I'm not overly exposed in case, gravity takes hold.
And it's also so many science references in that sentence. I loved it. But there's also the reality that a lot of people who have current exposure to the market through index funds, that itch is scratched, with a lot of these funds, or these stocks, which once listed will be part of those index funds that they hold. So, and again, that's a knowledge piece. Do you know enough about the holdings that you have to understand what you are currently holding within those baskets? And companies like ours are able to talk to our clients about that and say, okay, well, let's have a look at your portfolio. Let's see what your exposure is. Let's see how it correlates with your risk appetite, with your stated goals. There are some really cool products we have in the US. We're hoping to expand globally, which allow you to create your own indexes. So Schwab personalized indexing, which has been really successful in the US, because you can take out the companies you don't like, put in the ones you do, and effectively create your own index, which is again innovative, but it gives people control and diversification.
It also, I asked earlier, can AI tools run ahead of what firms like Schwab can provide? And the answer is, well, no. You're doing exactly what people are.
But again, trying to harness it in a safe way. And I think that's the key. I think the risk with AI, and particularly relying on AI to manage your portfolio for you, or to manage your own investment decisions. I think, again, I personally prefer the phrase augmented intelligence rather than artificial intelligence, because it should be a tool that helps you with managing your life and managing your decisions, but not making them necessarily for you.
We're almost at the end. I'd love to just get your 2 cents on the most outlandish or wild headlines you've seen in finance recently.
There's been a lot of talk about bubbles recently, and even this week, and the wisdom of the crowd. I quite like the history of investing.
Okay.
And what I've been reading recently is more about historical bubbles and how history sometimes rhymes without necessarily repeating. The South Sea Company bubble of 1720. Are you familiar with that one?
No. I missed that one.
A couple of really interesting things about that bubble. It was huge, and it burst very fast, and a lot of people lost a lot of money.
Okay.
But one of the people who lost nearly all of his money was Sir Isaac Newton.
Oh, no way.
So when you think about the wisdom of investors, he was a polymath. He was an exceptional scientist.
Yeah.
Probably one of the smartest people this country has ever produced.
Yeah.
And he was still subject to the same emotions about investing, fear and greed, as the rest of us.
Gosh.
And so he lost everything. And the quote that he said at the time was, I can predict the movement of the stars, but I can't predict the madness of men. And I think about that in the context of bubbles. The other thing that I learned reading about this recently was, at that time, after the bubble burst, and lots of people lost a lot of money, so that the share price of the South Sea Company went from £50 to I think £1,000 within a few weeks, and then bang, gone. And it was the first real debt equity scheme, and the people who were deemed to have pumped it up, there were repercussions. And in fact, the Chancellor of the Exchequer at the time, he had taken £20,000 of shares in the company in return for his political support. He was locked up in the Tower of London.
Oh my goodness!
I just think that maybe the FCA could consider, those doors still lock. So the FCA could consider reading that book and thinking about how the future enforcement of the people subject to the bubbles.
No, lesson to be learned.
Yeah,
fantastic, Richard Flynn. It's been an absolute pleasure. I've learned tons. I'm sure everyone else has too. Thank you so much for joining me.
Thank you, Carl.